I'm looking at the Goldman speed to power numbers. And if the consensus is right about $527 billion in Capex for 2026, we aren't just in a tech cycle. We're in a structural energy war.
It's the number nobody wants to believe, right?
Nobody.
Everyone's staring at their terminals. They see the infrastructure pullbacks since, June? And they think the trade is over. The momentum's broken.
Right.
But you actually read the report? That $527 billion? That isn't the bull case. That's the consensus. And you know the history of consensus here.
I do, but help me reconcile this. The market it's completely schizophrenic right now. You've got investors absolutely punishing the infrastructure stocks, dumping the builders, the power companies, the hardware guys.
Because the margins are squeezed.
Margins are squeezed, debt loads look scary. But at the exact same time, the analyst revisions for spending are going vertical. I mean, $465 billion was the number a few months ago. Now it's $527. How does that work? How is the spend going up while sentiment goes down?
Because the sell side is still chasing reality. I mean, look at the track record Goldman put in the report. Go back to the start of 2024. What was consensus for Capex growth then?
It was around 20%.
20%, exactly. Start of 2025, same thing, 20%. They just flatlined it.
And the reality
was over 50% growth both years. Wall Street consistently, systematically underestimates the sheer capital intensity here.
So this isn't a software update.
That's the disconnect. People treat this like a SaaS rollout. It's not. It's a mandatory rewiring of the physical world.
Okay, let's unpack mandatory, because that's the pushback I'm getting from our LPs. They see $500 billion in 1 year, and they scream,
.com crash.
They see fiber to nowhere. They see Cisco in 2000. Is this a bubble, or are we just losing our minds?
Well, if you look at nominal dollars, sure, it looks terrifying. But nominal dollars are a distraction. You have to look at the GDP metric in the Goldman note. That's the chart that matters.
The 1.5% barrier.
The 1.5% barrier. Right, let's just strip away the hype. AI, CapEx, chips, data centers, the grid. As a percentage of GDP, we're sitting at roughly 0.8%?
Feels high.
It feels expensive. But now you compare that to the last two times we fundamentally re-architected the planet.
The railroads.
The 19th century railroad boom and the 90s telecom cycle. In both of those cases, Capex didn't top out at 0.8%. They peaked at 1.5% of GDP or higher.
So you're saying, just to be clear, despite all the headlines about overspending, we're basically only halfway up the mountain compared to the railroad era.
Historically, yes. To hit that 1.5% benchmark, which, mind you, was what it took to build the tracks that connected the continent.
Yeah.
We would need to hit $700 billion in Capex in 2026.
$700 billion.
That is a $200 billion upside to the current estimates that people are already calling shocking. So, to answer your LPs, no, it's not a bubble. Not yet. We weren't even at the top of the curve.
That puts the equity market into perspective. The hyperscaler correlation, was 80%?
Used to be. They all moved together.
And since June, it's fallen off a cliff. Down to 20%, the market is actively picking winners and losers now.
And they're rewarding the platform stocks, the databases, the software.
While dumping the people actually pouring the concrete?
It's cynical. The market is greedy. They want the AI revenue, the productivity miracle, without the messy, expensive infrastructure bill.
Magic without the masonry.
Exactly.
No.
But Goldman is clear. The constraints aren't cash. These companies print money. The balance sheets are fine. The real constraints are supply bottlenecks and, quote, investor appetite.
So can we physically build it fast enough? And will investors lose their nerve before the grid is ready?
That's the question.
Which brings us to the real bottleneck. We need to pivot. We're talking dollars, which is fine for an earnings call, but we need to talk gigawatts. Money is useless if you can't plug the rack in.
Compute is the new oil. I know. People roll their eyes at that phrase.
It's a cliche.
It is, but it's not a metaphor anymore. It is a literal supply chain reality.
Walk me through the JPM analysis on this. They're axes of conflict, which is a terrifying way to frame a report. Axis 6 was just stark.
Axis 6 is the energy reality check. The headline is that the US and China alone will account for 80% of global data center energy growth by 2030.
80%.
We are shifting from a currency-based economy to an electron-based economy. And if you don't have the electrons, you don't have GDP growth, period.
This is where the Electrostate idea comes in. I found that fascinating. The report zeroes in on the Middle East, Axis 4. We think of them as oil exporters, but the strategy is completely shifting.
It's the ultimate pivot. Look at the UAE, look at Saudi Arabia. They aren't just playing around anymore. They're leveraging their energy abundance to become the dominant AI hubs for that whole hemisphere.
They know the oil runs out eventually.
Maybe it's 20 years, maybe it's 50.
Yeah.
But it ends. So what do? They use their sovereign wealth funds, Mubadala, the PIF, to buy the operating system of the future. The UAE's National AI Strategy 2031. That's not a press release. They are targeting 40% of their GDP from AI.
40%.
That is a complete rewiring of a national economy.
And the Saudis are putting serious capital behind it. The PIF's $40 billion fund, Humane Ventures. But what really caught my eye wasn't the VC checks. It was the hardware. 18,000 NVIDIA GB300s, that is a massive stockpile.
It's the new strategic reserve. I mean, think about it. For 50 years, we stockpiled crude oil in salt caverns. Now, nations are stockpiling H100s and GB300s.
So the cynical take,
and the one we have to trade on, is that Silicon Valley is running out of the one thing the Middle East has in surplus.
cheap, guaranteed power.
Cheap, guaranteed baseload power. Exactly. You can have the smartest engineers in Palo Alto, the best algorithm in the world. But if you're in Northern Virginia and the utility tells you there's a 5-year wait for a new substation, well, your AI roadmap is a hallucination. It just doesn't exist.
And the UAE and Saudi are saying, we have the power, we have the grid, bring your chips here.
That's the pitch.
But that's a massive geopolitical fracture. It's not just about efficiency anymore, it's about sovereignty. JPM has that term, geopatriation. Awful word.
It's a terrible word, but it's an important concept. It's axis 2 and 3 in the report. And yeah, it's an ugly word for an ugly reality. The world is fragmenting. This is the end of the global internet and the beginning of walled-off sovereign ecosystems.
Why? Fear.
It's pure fear. Nations are realizing that if their critical data is processed in a foreign data center, they are completely vulnerable. Vulnerable to energy blackmail, to intelligence leaks, to just having the switch flipped off. So they want the compute inside their borders.
You see Europe absolutely freaking out about this. They look at Microsoft, Google, Amazon, and realize they're just client states. They have no domestic capacity.
So now we get the Eurostack.
A 300 billion euro project.
The estimated project.
Yeah.
The idea is to build independent European infrastructure so they aren't dependent on the U.S. Now, whether they can actually execute, that's another question. The European regulatory environment isn't exactly built for speed.
But the intent is clear. They want tech sovereignty.
Right.
So Europe tries to build a moat. The Middle East buys the castle. What is the U.S. doing? Because that July 2025 executive order, that did not feel subtle.
It was a sledgehammer. The JPM report calls it a repositioning. The U.S. response is just all-out American energy dominance, fast-tracking permits for everything. Fossil fuels, nuclear, grid upgrades. They are looking at federal land to put power plants on, specifically for data centers.
It's ironic, isn't it? 20 years of ESG mandates, and now the policy's basically burn whatever you have to because the models need more juice.
It's a recognition that environmental reviews became a national security liability. That's the shift. If you can't build the power, you lose the AI war to China. Which, brings us to the elephant in the room, Axis 1.
China, their approach is the polar opposite of ours. We have this chaotic private sector scrum. They have a state-led whole-of-nation strategy. And looking at the data, it's working in places we didn't expect. I keep hearing about DeepSeek.
The DeepSeek factor is critical for our models. Everyone wrote off China after the chip bans. They can't get H100s, they're dead.
Yeah.
But DeepSeek is winning on cost. The JPM data shows their token costs are just drastically lower than U.S. models.
I saw some of those numbers. Are they real? Is the gap that wide?
It's massive.
Yeah.
Depending on the model, you're looking at token costs that are 90 to 98% cheaper than a U.S. frontier model.
98%. That completely collapses the margin structure for everyone else.
Right. Now, there's a quality debate. The NIST report suggests the effective cost advantage is maybe closer to 35% when you factor in security and reliability. But still, if you're a mid-sized enterprise or a developing nation and you can buy Chinese intelligence for pennies on the dollar, what do you choose?
They're using open source to flood the zone.
And we're in this weird spot with export controls. We're trying to strangle their hardware supply, but we still need the revenue. That detail in the report about the 15% tax on chip sales to China that goes to the U.S. government?
It's a trade war disguised as a tech boom.
We're taxing their access to our old chips to fund our own R&D, but it's a leaky bucket. The report's clear. Despite the bans, China's research output and talent retention are surging. They're building a self-reliant ecosystem much faster than we thought.
Okay. So energy war, sovereign fragmentation, price collapse from China. Let's get to the sharp end of the stick. Defense. Axis 7. This felt like the most under-discussed part of the report.
This is the so what for the fund.
Yeah.
I mean, if you're holding legacy defense primes, the company's building billion-dollar carriers, you have to look at what's happening in Ukraine. You have to understand decision advantage.
Explain it quickly.
ODA loop. Observe, orient, decide, act. Whoever does that loop fastest wins. AI compresses that loop from minutes to milliseconds. If I can see you, analyze, and fire before you even know I'm there, you lose.
And the legacy primes are not built for milliseconds.
They're built for 20-year procurement cycles. And that's why the report is so bearish on them. Look at Ukraine. It's not tank battles deciding things. It's swarms of low-cost drones, attritable systems, things you can afford to lose.
A $500 drone taking out a $5 million tank. The economics are inverting.
Completely. JPM is explicit here. The defense industrial base is too slow. It's built for boutique, high-cost production. It cannot churn out 1 million intelligent drones a month.
So for us, the alpha isn't in buying the company that makes the steel.
No, it's the kill chain integrators, the companies bridging that gap between innovation and acquisition, the software players that can plug AI into existing platforms. Because if you can't do that, you don't have deterrence. It's that simple.
So let's pull this all back to strategy for 2026. We have a market terrified of a Capex number that we think is actually too low. We have a huge divergence where infrastructure is being sold off, even though the physical requirements, energy, concrete, are mandatory.
The volatility in 2026 won't come from the tech itself. The models work. The demand is there. The volatility will come from the constraints.
The bottlenecks.
The energy constraints. The geopolitical walls going up. If the UAE decides to lock down its compute for domestic use, that's a supply shock. If Europe slaps a tariff on US data, that hits revenue models. If DeepSeek undercuts pricing power, that crushes margins. That's the risk.
It's a structural squeeze. We're long the rewiring, but we have to be incredibly selective about who actually has the power, literally the permits, to execute.
And we have to watch the grid. That is the ultimate choke point. We're plugging a new machine into an old system that was never designed for it.
That's the nightmare scenario. If JP Morgan is right and OpenAI really needs a full terawatt by 2030, does the civilian power grid even survive the transition?